We have seen a sharp rebound in the financial markets in January 2019, which will stay as one of the best months of January in the history of the stock markets. Fundamental data did not change dramatically, but we had a couple of better than expected figures, especially employment figures in the US. And very importantly, we have seen the central banks, especially the Fed and the ECB, changing a little their communication and being a little more dovish. So we had a nice rebound in equity markets. Economic growth is slow in the Eurozone, and we had to revise down our forecast for this year and next overall in the Eurozone countries. Domestic demand remains solid, especially consumption, and so our main scenario remains that we will not have a recession in this Eurozone. However, because of the political uncertainties, and we talk about the trade tensions and the Brexit, pressures are coming on economic growth in general, and so we had to revise down both economic growth and inflation forecasts. In this low growth environment for the Eurozone, we have changed our forecast for the ECB. So the end of quantitative easing has been decided, it has been implemented, but we were expecting rising refi and depo rates this year. We have changed this assumption. We expect no more hike by the ECB this year, meaning that the ECB will continue to be extremely accommodative. It has an implication also for our bond forecast. We were expecting the 10-year German yield to go to 1%. We lower that level to 0.75% in 12 months. It means that the yields in Europe will go up because the current level of 17 bips is clearly too low, but the rise in bond yields we expect is lower than it was before. Concerning the Fed, we also changed our forecast because the Fed already is talking more dovish. We think that they will pause for the next 6 months. They are data dependent. And we think that in 2019 we will get only one hike by the Fed by 25 bips. It should be around June of this year. Then that will be the end of this tightening for this economic cycle. However, we don't change our target for the 10-year Treasury, and also we don't change our target for the euro-dollar, which should stay around 116 for the next 3 months and 122 12 months. So we stick to the positive view concerning equity markets for 2019. Yes, we had a nice rebound in January, but that is coming from a very oversold position at the end of the previous year. So the rebound is a reconnection of the financial markets toward fundamentals. And we were talking last year about a deconnection between markets and fundamentals. The fact number one is that economic growth is slowing, but we exclude the risk of recession. It has implications for the earnings growth. Yes, earnings growth are slowing, but they stay positive. The consensus of analysts is revising down its forecast for this year, but we think earnings growth will continue to be positive. The second positive aspect is coming from monetary policies. As we said, the Fed and the ECB are more dovish, but we have also a strong support coming from Chinese authorities in terms of monetary policy, but also fiscal policy is stimulative, and we are seeing infrastructure spendings, for example. Overall, growth will be positive. Earnings power from corporation is also positive, which means that we will have higher dividend, buyback programs, probably M&A activities. Overall, we stick to the positive view concerning equities, and we don't change our country recommendations. We still prefer emerging market number 1, Japan number 2, and the Eurozone in number 3. We stick to the neutral stance concerning the US, essentially because the short end of the yield curve is offering a good return, and so there is a sort of competition between equities and bonds, which you don't have in the Eurozone, for example. In terms of sector, we are not making a big change this month, but we adjust two things. One is we become negative on the food retailing sector, and secondly, we become positive on the rates. Listed real estate is offering a 4% dividend, which is well covered by stable earnings, and the valuation improved last year quite significantly. Thank you for your attention.